Assalamualaikum to Doctor and my friends. My name is Nafisa binti Muhammad Najib, matric number 268010. I'm from Group 6, representing Audit of Long-Term Liabilities, Shareholder'S Equity and Income Statement. Firstly, Audit of Long-Term Liabilities. So what is Long-Term Liabilities? Long-Term liabilities, also known as non-current liabilities, are liabilities that are due after a year or after company regular operating cycles. Long-term liabilities inform the user of the amount of debt owned by the company in the current period. Next, auditing long-term liabilities. Long-term liabilities debt is treated by the auditor in the same way as any other financial statement account. The auditor must be satisfied that the amount shown on the balance sheet from the different form of long-term liabilities are not materially incorrect or misstatement. This occurrence include the correct recognition of interest expense on long-term liabilities in the financial statement. The approach of long-term liabilities auditing differ according to the frequency of the entity financing activity. Next, control risk assessment for long-term liabilities. Firstly, when using a substantive procedure, the auditor must have a thorough understanding of the entity's internal control mechanism over debt transaction to predict the type of misstatement that can occur. The discussion of control risk management for long-term liabilities that follow focus on the general types of control activities that should be present to reduce the possibility of material misstatement. The auditor is most concerned with the assertion of occurrence and authorization, completeness, valuation, and disclosure classification. There are 4 assertion and related control activity. The first assertion are occurrence and authorization. To begin, appropriate documentation must be created and maintained to ensure that a note or bond was properly authorized. A properly signed loan agreement, for example, can enable the auditor to decide if the transaction was properly executed. Next, the board of director or executive given this authority should then authorize any major debt obligation. Entities that borrows on a regular basis should have both general and specific control in place. Second, assertion or completeness. The entity should keep accurate record of long-term liabilities transaction and ensure that all borrowings and repayments of principal and interest are recorded. Maintaining a subsidiary ledger containing details on all the entity's long-term liability owning is one of the methods of handling detailed debt transaction. Regularly reconcile the debt sum reported in the subsidiary ledger to the general ledger. Trade assertion or valuation. Transaction involving notes and bonds are reported in the accounting report at their face value, plus or minus any premium or discount. To calculate interest expenses, premium or discount should be amortized using the effective interest method. The valuation of advanced financial instrument is much more complicated compared to the regular financial instrument. Control should also ensure that notes and bonds are classified correctly in financial statement. The main concern is that controls are in place to ensure that the portion of long-term liabilities due over the next year is appropriately categorized as a short-term liability. Next part is substantive procedure of long-term liabilities. A substantive procedure of auditing of long-term liabilities entails reviewing all new debt agreements, assessing the status of previous debt agreements, and checking balance and other related details with third parties. Because of the direct relationship between long-term debt or liabilities and interest expenses, substantive analytical procedures are useful in auditing interest expenses. For example, the auditor could calculate interest expense by multiplying the 12 monthly long-term liabilities balance by the average monthly interest rate. Following that, interest expenses could be calculated by comparing this calculation to the amount of interest expenses reported in the general ledger. If the two figures does not vary significantly, the auditor may conclude that interest expense is fairly reported and vice versa. That's all for me. I will pass the next slide to my friend. Thank you.
Hi, my name is Muhammad Al-Amin bin Abdul Hamid. My matric number is 272518. I will present about auditing of dividend. Okay, first of all, what is dividend? Dividend is the payment received from the company as a return of share capital. There are two types of share capital, which is ordinary share and preferred share. Preferred share will get fixed return for their capital, but ordinary share is depend on the company profit or loss for the year. Okay, next is auditing dividend. All dividend declared and paid will be audited because of concern of valuation of corporate bylaw or debt covenants. There are two ways that auditor can check for dividend, which is using the outside agent for declaration and paid dividend. Next is not using the outside agent for dividend, which is direct to the board of director. Okay, next is there are three audit procedure, which is completeness, existence, presentation, and disclosure. Okay, completeness. Completeness. Taking note of both the minutes of client, inspecting the supporting document of dividend declaration, verifying the recording of dividend for the current year. Okay, the aim of this procedure is to find the right amount of dividend declaration for the year. All documents that related with dividend will check by the auditor. Okay, next is existence. Verify all the documents regarding the declaration and payment of dividend through accounting period. Inspection the minute that have been approved by Board of Directors as dividend of declaration. Verify the recorded dividend in the current accounting period. The purpose of this procedure is to get appropriate evidence related to dividend declaration and paid during the year. The total amount and transaction in the account will be gathered to ensure the existence of dividend during the financial year. Okay, next is presentation and disclosure dividend. Confirming the dividend and return earnings are recorded through account in the financial statement. The disclosure with respect to dividend rate, preferred dividend, and areas of dividend should also be made in the financial statement. Okay, the aim of this procedure are to ensure and confirm the dividend are recorded in the financial statement and adjusted in the return earning. The dividend payable must to be recorded and the declaration of dividend are disclosed in the financial statement. Okay, that's all from me. Thank you.
Hi, Assalamualaikum. My name is Noizati binti Tarmizi, matric number 272193. Okay, now I would like to present about idea of share capital. Okay, next, the capital stock accounts include common stock, preferred stock, and paid-in capital. When auditing the capital stock account, the auditor is normally concerned with the occurrence, completeness, valuation, and completeness of the closure at section. Let's move to the first one, which is occurrence and completeness. An independent registrar and transfer agent are used by the entity. The auditor confirm the total number of shares outstanding at the end of the period. If the amount of shares listed has outstanding on the confirmation reconciled to the general ledger capital stock accounts, the auditor has evidence that the total number of shares outstanding at the end of the year is correct. But if the entity doesn't know use outside agent, it will maintain a stock register and or a stock certificate book. The auditor may perform the following procedure. As you can see on this slide, the first procedure is change the transfer of share between stockholders to the stock register or stock certificate book, accuracy and completeness. For second, put the share outstanding in the stock register and or stock certificate books and agree them. to total share outstanding in the general capital stock account. Third, examine any cancelled stock certificate account for the inspect any unissued stock certificate in the stock certificate book. Second one, valuation. When capital stock is issued for cash, the assessment of proper valuation is straightforward. The par of stated value for the share issues is assigned to the respective capital stock account, while the difference between the price and par value allocated to paid-in capital. The auditor can recompute the value assigned to each transaction. The proceeds from the sale of stock are normally traced to the cash receipt records. For the second one, when equity capital is exchanged property, good or service, the valuation issue is more complex. Generally, fair market value is an issue, and the accounting may involve a gain or loss. For third one, stock dividend may also create complex auditing issue. The auditor must recompute the dividend and trace the entry to the general ledger. Okay, the last one is completeness and disclosure. A number of important disclosure are necessary for stockholders' equity, and there is several example of disclosure item. First one, number of share authorized, issue, and outstanding for each class of stock. Second one, call privilege, price and date of preferred stock. Third, stock option of purchase plans. Next, registration of retained earning and dividend. Last one is any complete or pending transaction that may affect stockholder equity. That's all from me. Thank you.
Good day, Doctor. My name is Christina Wungyue, metric number 270,848. Now I would like to present auditing of reserve and retained profits. Under normal circumstances, retained profits are affected by the current year's income or loss and the dividends declared or paid. The major exceptions in auditing reserve and retained profits are the prior period adjustment, correction of errors, stock retirements, and changes in appropriation of retained profits. Next, I would like to present about the audit procedures for reserve and retained profits. First, auditors have to obtain schedule of account activity for that particular period. Secondly, auditors shall ensure that the beginning balance is agreed with prior year's working papers. Next, auditors should ensure that the net income or loss can be traced to the income statement and verify the amount of cash dividends or stock dividends. Besides that, auditors need to trace the new appropriation or changes in existing appropriation into the contractual agreement. Lastly, auditors shall ensure that necessary presentations and disclosure are made. Thank you.
Assalamualaikum warahmatullahi wabarakatuh and a very good day. My name is Adi Aziman bin Afendi, metric number 272686. I will be presenting 5.0 Auditing Income Statement. So, income statement accounts are those accounts in the general ledger that are used in firm's profit and loss statement. These accounts are usually positioned in the general ledger after the accounts used to compile the balance sheet. An income statement audit is the examination of an entity's income statements and accompanying disclosures by an independent auditor. The result of this examination is a report by the auditor attesting to the fairness of presenting of the financial statements and related disclosures. Next, the purpose of an income statement audit is to add credibility to the reported financial position and performance of a business. A lender typically requires an audit of the income statements of any entity to which they lend funds. Generally, there are three primary stages of an income statement audit, which consists of planning and risk assessment, internal controls testing, and substantive procedures. The planning and risk assessment stage involves gaining an understanding of the business and the business environment in which it operates, and using this information to assess whether there may be risks that could impact the financial statements. The internal control testing stage involves the assessment of the effectiveness of an entity's suite of controls, concentrating on such areas as proper authorization, the safeguarding of the assets, and the segregation of duties. This can involve an array of tests conducted on a sampling of transactions to determine the degree of control effectiveness. A high level of effectiveness allows the auditors to scale back some of their later audit procedures. Finally, the last stage is substantive procedures, which involves a broad array of procedures of which small sampling includes analysis, cash, market securities, account receivable, inventory, fixed assets, account payable, and debt. An audit is the most expensive of all the types of examination of income statements. The least expensive is a compilation, followed by a review. Due to its cost, many companies attempt to downgrade to a review or compilation, though this is only an option if it is acceptable to the report recipients. That is all from me. Thank you.